Hello guys, I go by the name of Omar, aka Ammarullah. So a lot of people have been asking me what type of strategy do I trade. I should show them what do I trade, how do I trade, because in a lot of times of chaos and uncertainty, they will see me catching some moves like this or something when they are like afraid of the market or anything. So in this video, I'm going to break down all the reasons that made me take this trade so that you will know the kind of strategy I trade normally. So follow me and watch the end of the video. If you are not following, you should do that now. Like and subscribe to my channel. Let's go. So I will show you from the beginning of these movements. Before everything happened, I will delete everything that's here and start afresh. Let's go there. So we always start from top-down analysis whenever we are making analysis. Let me go to daily and show you from daily. So when I come to daily, when everything did not happen, when I came to daily, the first thing I saw was the high that was there before everything was this high. It was the high, so I marked my high first. I marked my high, and we have this imbalance of price. I marked it whenever we are doing analysis. We always look for liquidities and imbalances. That's how I do. The first thing I go to whenever even if I'm in the higher time frame or the lower time frame, the first thing is to find the liquidities. Where are the liquidities and where are the imbalances of price? You understand? Where is price likely to go? And first is to look for the structure of the market, uptrend or downtrend. Then look for imbalances of price, then liquidity or anything. Then I have this imbalance and this high on daily. Then we go to 4-hour time frame, the time frame that is lower than that of daily. So in 4-hour we have this liquidity void, this imbalance again, and these are our liquidity levels. This low, before this happened, this low was our liquidity level. The analysis that I just deleted was made on 15 minutes time frame. The trade was took on 15 minutes time frame. So this, I'm just showing you how I did the analysis before. I check my 1-hour time frame. 1 hour, what's 1 hour showing me? 1 hour was showing me this was my strong high, my high, the high that I drew from daily. Then we had this breakup structure from here. This was the high of 23rd. The trade was took on 24th. That's the next day, a day before Christmas. On the 25th of December, the market was closed. You understand? So I made the analysis on the 24th and I took the trade on the 24th. So after we had this break of market structure from here to here, break of market structure, what do we have behind here? We had this imbalance of price that price did not reacted to. So they are now inversion fair value gap. We call them inverse fair value gap. They are now inversion fair value gap since the price came and went straight down without reacting to them. This is the first thing we had in mind. There is possibility of if price is to come back to them, it may likely react to that particular level, right? It may likely react to that particular level. Since the first time when it came, it did not react to them. So there may be a possibility of the price now to react to them. So break of market structure and the price came back, but and we had this order block, right? We had this order block. So as the price broke structure, when it's coming back, it did not reach the order block, right? Then it's spook higher, consolidates this high, that is spook high, without reaching the order block. So this low now is now an inducement level. It's now inducement to induce people to think this is the ending of the downward movement. They will start buying from here and place their stop loss below this low. So the market will likely come back to take them out and tap the main demand zone, the order block, right? That is what we expect always. So I jumped down to 15 minutes time frame after 1 hour to have lower risk, 30 minutes, to have lower risk and to have more confluence that will support the analysis. So when I jumped down, I noticed that from here to here, the market already reacted to some part of that inverse fair value gap that I drew. So I reduce it. I make it from the low of this candle, right? From the low of the candle to the high of this one, right? So that is now the inverse fair value gap that we have. The market will likely react to it. Now, how many confluence do you have? We have one, right? We have one confluence, inverse fair value gap, where market is likely, when it come back after break of market structure, when it come back to that, it's like it will likely react to that, which it did as the market tapped the inverse fair value gap. It's, if you notice, it reacted, then consolidate. It made this inducement. We have two now, two inducement level inside the inverse fair value gap, and we have this little gap here, right here, which will support the reversal of the market to reach our order block, right? So have it, even though the market already clicked it, but it did not feel it completely. So there may be a possibility of the market to come, even if not to react to the fair value gap, but to reach the main order block, right? So the market sell down below the order block. This was where I entered the market, right? This was where I entered the market. Now, how many confluences do we have? We have inverse fair value gap, inducement level, and order block. Above it, a little gap. That was where I placed my buy and targeted the opposite side of liquidity. Stop loss below my order block, right? Below my order block. So that was it. It's very simple. It was very simple. It's just to spot when you just enter your market, you should look at where are the liquidities, where market is likely heading to, right? Then look for imbalances of price. All these things are magnets. A magnet that may catch the price and make the price react from there, right? If they are to act from a fair value gap or inverse fair value gap or anything, the other possible place to go is to go to the opposite side of liquidity, where liquidity resides. So that's it. Thanks for watching.